Welcome to this episode of the Greater Phoenix Chambers podcast, Let's Talk Business Phoenix, with me, your host, Todd Sanders, President and CEO of the Greater Phoenix Chamber. In each episode, we tackle important issues and subjects affecting our businesses, our community, and the state today. Through relevant, timely topics, this podcast serves as the business community's voice with the mission of championing business growth, identifying problems that restrict economic development, and conveying community leaders to move Phoenix forward.
Let's Talk Business Phoenix was produced in partnership with Ideas Collide, an agency offering a full suite of custom marketing solutions for your brand's unique challenges. Make a connection at ideascollide.com.
Welcome back to the podcast. We are honored today to have Steve Wyett, who's the Chief Investment Strategist for BOK Financial. He's part of our Economic Outlook program. He's here with us today. Steve, welcome back.
Todd, great to be here. I'm really looking forward to our conversation today. I think we got some interesting stuff to talk about.
We really do. And, I think when we have you for Economic Outlook, we usually we'll hear back from folks for a number of days about how much they learned, how much information's out there. And you were kind enough to come back sort of mid-year to give us sort of an update. So when we heard you last, you talked about potential soft landing of the economy.
Right.
Where are we now?
Until the CPI came out this morning, I would say that's definitely where we were. And look, I do think that's still where we are. And let's just define what a soft landing is, if as we think about what that may mean from a Fed standpoint, because the way the Fed uses monetary policy to try and alter economic activity, or in this case, really, what's been the biggest thing that's been our problem since we came out of the pandemic was inflation. And we saw inflation go really high, CPI peaked over 9%. The way the Fed thinks about their monetary policy, they use interest rates as a tool to try and control economic demand, which in effect then has a secondary effect on inflation. So as inflation's moving higher, the Fed is raising interest rates. That has the impact of historically slowing economic activity. That reduces demand from consumers. That allows supply to catch up with that lower demand, and prices will fall. That's kind of the transmission mechanism of what the Fed's trying to do. Here's the hard part. And I can remember, Todd, when the Fed started raising rates in March of 2022, and they'd kept rates near zero, remember, coming through the pandemic, actually all the way back to the financial crisis in 08 and 09, where it was the first time the Fed took interest rates to zero and held them there for a long time. Unprecedented. That's right. In 2018, they tried to raise interest rates and they got them as high as 2%, and then the economy slowed down again. So they went back to zero. And then, of course, when the pandemic hit, it was we're just taking them right to the floor. They supported the capital markets. They did some other things to inject liquidity, not the least of which is doubled the size of their balance sheet. They were actually buying treasuries and even some corporate bonds to support the market. Those lower interest rates are meant to spur economic activity. Lower interest rates, from a business standpoint, that makes more projects profitable because the hurdle bar of what your cost of capital is lower. But on the flip side, then when they raise rates, that makes the hurdle bar a lot higher, and that's why it tends to slow demand. When the Fed started raising rates, I can remember Fed Chair Powell walking out of that first meeting at his press conference, and he looked directly into the camera and he said, "I want to talk to the American people. We understand we have to get inflation down, but the actions we're going to take are going to cause some pain." Now, the pain that we normally see from higher interest rates, and as the economy slows, you think about the economy slowing, companies start making a little bit less money. How do they respond to that? They normally start cutting costs. And one of the biggest costs that they'll start laying off people. So we see unemployment start to rise.
So the Fed, that was their goal. We knew
that was
going to be some pain.
That was the pain that Fed Chair Powell was talking about. And when you think about labor force in the United States, we have about 160 million makes up our labor force. A 1% increase in unemployment, that's 1.6 million jobs. So that can be uncomfortable. That's an uncomfortable thing to kind of think about, that the Fed it's not like they're saying we want to put people out of work, but the end result of what their actions are normally that's what it does. I can remember thinking as Fed Chair Powell did that wow, that's different than what we've seen in the past. And the way the Fed has communicated with the markets has evolved a lot. When I got in the business in January of 1982. So this was way back in the old days. Paul Volcker was the chairman of the Fed during that period of time.
Curve, right?
And for those listeners that can remember, interest rates were very high because inflation had gotten away from us, and the Fed had to raise interest rates dramatically at that point. And even though unemployment in the U.S. was at 10%, the Fed had to keep interest rates high because inflation was just hard to get down. So at that point in time, Todd, the Fed didn't talk to the public at all. Chair Volcker would have to make testimony to Congress twice a year in what was called the Humphrey Hawkins testimony. That's the only time the Fed talked, that people could ask the chair, what are you doing? And it was a real art form for the Fed chair to say nothing while speaking English as he was trying to answer these questions. So fast forward to today, where after every meeting, Fed Chair Powell comes out and has a press conference, says, here's what we did, here's what we're thinking, here's why we're thinking about it. It's just so different than it used to be. So I think the point of this is that the Chair Powell has, over the course of his chairmanship, wanted to continue to increase the transparency of what the Fed is doing. The Fed went on a national kind of a listening tour, if you will. It was called the Fed Listens, and they just talked to people about monetary policy and what they were thinking and how that impacted people. So I think that the Fed does have a better sense. When you get down to it, the Federal Reserve is filled with a lot of really smart people. These are people that are highly educated. It tends to be a highly analytically driven type of a committee. They've got hugely complex econometric models that they built that try to take all of the inputs, and just thinking about how complex the U.S. economy is, much less the global economy. It's impossible to create a model that will absolutely tell you what's going to happen, but that's what they try and do. And it's very analytical. Fed Chair Powell in that press conference was not talking from an analytical standpoint. He was trying to explain what we should expect from an outcome. Now, I've got to tell you, Todd, that put us in a position where, as we went through 2022 and then in 2023, we were cautious on our outlook. When I came to the fall conference in 2022, I laid out a pretty clear case of why the economy was going to continue to slow and that unemployment was going to go up some, but that was what was needed for inflation to fall. Well, as we went through 2023, that's not what happened. We did see inflation come down, but at that press conference in March of 2022, the unemployment rate in the United States was 3.6%. We just got a report last Friday, and the unemployment rate in the United States is 3.8%. So we saw the Fed raise interest rates by 5%. And not only did the economy not slow down, it's accelerated, and unemployment's only up by 20 basis points. An unbelievable economic outcome, really different. I think there's some reasons for that, and we can talk about that. Yeah. But this soft landing is the idea that the Fed could raise rates enough to see inflation come down, but we don't see unemployment go up, and the economy can continue to grow. That was a very low probability outcome as we thought what was happening in 2022 and 2023. As we sit here today, that looks like the most probable outcome.
It's such a difference.
Completely different. And I just have to say, look, if we're going to be wrong, I'd rather us be wrong because things are better than what we were anticipating. But if we can, and it's not, there's still possibilities. I would say recession risks have receded a lot. They're not gone. There's still things that could push us in that direction. But if we can accomplish this, it's a huge win for our economy. It's a huge win for the Fed. It's a huge win for the markets. It's a huge win for American consumers and job holders that if we can see inflation come down. Now, this is the hard part about the inflation data that we're getting now, and really the last 2 to 4 months, is that improvement in the inflation has slowed down a little bit. It's still coming down, but it's not coming down as much. And there are some parts of the inflation picture that look like they might actually be turning up a little bit. This is why the Fed is, they're just cautious about lowering interest rates too quickly. There's still a lot of underlying demand in the economy. They don't want to ease too quickly and see us spur a secondary wave of inflation, which has happened historically.
Happened to Volcker, correct?
Volcker was brought in to kind of clean up the mess of the person that was before him, which was a Fed chair named Arthur Burns. And so what I would tell you is Jay Powell much more wants to be remembered like Paul Volcker than Arthur Burns. And so, but the idea is that inflation does come in waves. And so the Fed's thinking, what can we do today that will keep this echo wave of inflation from coming? The hard part is it's not this month. It's really hard to look at 1 month and say, okay, here's exactly what's going to happen. But this is what's given the Fed pause. Inflation is not going to go away quietly. It doesn't appear. And there's just remains that question of how much, you think it's 3. Isn't that good enough? Their target's 2. They're only 1% away. That difference between 3 and 2 is a really big difference if we go over a number of years. So the Fed wants to get it to 2. I understand completely what they're saying. Inflation is probably the biggest factor that keeps our economy from moving forward in a homogeneous way. It impacts people way differently depending on what part of the income bracket you're in, and it really hurts the people that can least afford it the worst. So I applaud what Fed Chair Powell is trying to do. I consider that getting it back to 2% is important. He just got a tough job right now.
Well, absolutely, and it seemed like those first few percentage points came relatively.
It did.
Not that it wasn't painful, but it came down pretty fast, and now it seems like we're just plateaued. We're stuck. And it's that last percentage, to your point, that we just can't get off.
So we kind of call that the last mile of inflation. And so, look, you remember what the term was that the Fed was using about inflation early as it started up. The Fed was saying inflation is transitory. It's transitory. Yep. It turned out to be not as transitory as they thought. But if you start to break down inflation between the cyclical parts of inflation and the secular or parts of inflation, I'm not trying to get too wonky here, but we can see it in the data. Remember, as we went into the pandemic, we shut everything down. The big thing was, I mentioned the Fed did much what they did back in the financial crisis. They took interest rates to 0. Here was the big difference. As we came out of the financial crisis, where unemployment peaked at 10%, that was a really ugly period. It was a long period. And unemployment took the better part of 10 years to get down to 4% as it worked its way down. While the Fed did much the same thing, Congress didn't do much of anything. There was no fiscal policy response necessarily in the pandemic. And I think what Congress learned in that is, look, if we go through another period like that, we're going to act big too. And they did. And so, look, I know what the intent was. Remember, as we shut down the economy, Todd, man, the uncertainty was so high because we saw unemployment over the course of 2 months move from 4% to 15.3%. It was scary, right? And so I applaud the Fed and Congress for taking action to avoid what they wanted. They wanted to avoid the risk of an extended, long Great Depression type of an economic event. And if you just look at the data, they effectively avoided that. But as we think about things, it's probably the avoidance of one risk is the acceptance of the other. As you look at inflation today, we shut down the economy. We couldn't take trips. We couldn't go eat at restaurants anymore. But the federal government was sending all this money out. What did we do? We bought stuff. We bought a lot of stuff, including housing. And you can see in the inflation data that core goods inflation just spiked. It went up to as high as 12%. It's now back down. If we could figure out a way, Todd, to live on flat screen TVs, we'd be fine because flat screen TV prices are actually declining.
Pretty low,
They're declining. And I think that brings up another interesting point as we talk about inflation. As economists, we talk about inflation getting better. It's down. That doesn't mean prices are falling.
I think that's a misconception for people.
Going up more slowly.
Yes.
So it's it's kind of like when you see new budgets from the federal government and they say we've cut government spending. No, what they did is they just cut the growth rate. We're not going to spend as much more. My wife's a big proponent of that type of a definition. I tend to come on a different side of that. That's not a cut, but from an inflation standpoint, what you and I are dealing with, what consumers are dealing with, is just the aggregate level of price increases. So from January 1 of 2020 through today, it's roughly 20% on CPI. Now, remember, that's a fifth of our spending power that we've lost over that period of time.
People feel it.
Absolutely. There's a lot of economic ideas that we could talk about that not many people would understand or be interested in, but inflation is one that impacts everybody.
Yes. Absolutely. And we haven't felt it here in decades. One of the things that was discussed at one of our board meetings was that, thinking about people who are running today's companies, nobody who's running a company today had to deal with inflation, really, from the 70s, really. And so it's such an interesting place to be.
And I think that, that means risk management looks a little bit different for companies. The cost of capital was so low for so long because interest rates were being held down. It changed, the advantage of lower interest rates is it makes some of those projects that may have been a little bit iffy, you go ahead and do that. But the fact is the return on those are not as high as what some other projects would be. And so as you keep interest rates really low, you see projects get done that you're kind of like, I'm not sure that in a normal time that would have been a project that would have got approved. The hard part as rates move up, that's what slows down the economy. And we're seeing that there's still a lot of public infrastructure stuff being done. The government's still spending a lot of money. I want to talk about that a little bit. But in the private sector, you're seeing some slowdown on some projects. We've had huge increases in multifamily housing. But as we get through this year and those projects are done, as we look forward into 2025, 2026, not a lot on the drawing board.
Which will be interesting to see. But I think to your earlier point, the economy today is sort of defying the laws of economics, because even with some really aggressive cuts or increases in rates, we're still growing. What do you attribute that to? It's just the massive amount of money out there?
So there's really two things. That was it's a reflection of the fact that as we went through the pandemic, when I talk about the amount of money that the Fed or that the Congress put into the economy, it's $5 to $6 trillion, and a lot of that went directly into consumer pockets. Consumers are 66% of our economy, that 2/3 of our economy. Look, as long as the consumer's healthy, and that's why unemployment, it's so important to the economic outlook. If unemployment's going to stay low, you can find some cracks in credit card debt and auto loans and some stuff like that. But generally, this last unemployment report at 3.8%, Todd, that was the 25th month, I think, in a row of unemployment below 4%. That has not happened in this country since the 1960s. So just a fabulous performance by the economy. What we missed, as we were thinking about the potential for unemployment going up, is that the federal government would continue to spend the amount of money. Now it's different. They're not sending checks to individuals to put that in those pockets. But they just updated through the end of March our fiscal position for this year. It's a $1.7 trillion budget deficit. Now, that's going to get a little better as we go through April and May. That's big tax collection season. So it wouldn't surprise me to see there be some pronouncements about how much the deficit has improved as we go over the next couple of months. But the bottom line is this: we're still spending, deficit spending is 5 to 6% of our budget. It's a material 5 to 6% of GDP. It's a material amount of money, and it's unprecedented that we do that during a period that unemployment's below 4% and GDP growth last year, which averaged 3% for the year and was accelerating as we went into the end of the year. It's just unprecedented that we've continued to spend that amount of money. So
when we're not in a crisis.
We're not in a crisis. Short term, that's been highly additive to growth. And we can look at charts that kind of look at the growth rate in like the U.S. versus the European Union, going even back to before the pandemic. And we're both highly developed economies, roughly the same size if you look at the EU versus the U.S. in totality. Growth rate was pretty much the same. We both went way down during the pandemic, but coming out of the pandemic, the EU that's an economic union, but not a political union. So their ability to do coordinated fiscal response just wasn't there like it was here. And if you look at the growth rate of the U.S. economy coming out of the pandemic versus the EU, we're way better. So if you just look at it from that standpoint, what Congress did has allowed us to recover to a much greater degree than what they're witnessing in the EU. So kind of the way I think about this, Todd, if you take a snapshot of the economy, it looks really good. Low unemployment. Look, inflation's coming down. We've got positive GDP growth. We've still got positive retail sales. But how much airbrushing are we having to do to make that picture look that good? That's the term I'm going to use for all this deficit spending that we're doing. And it's not that deficit spending in and of itself is necessarily bad, but it's a question of how sustainable it is at the level that we're doing it now. So most people would say, and if you look at a forecast from the Congressional Budget Office, which is probably the most bipartisan scorekeeper out there of what's happening in Washington, and you just look at their forecast of how much public debt of GDP is going to be held by as we move forward, based upon current law, which would include the sunsetting of the 2017 tax cuts that were passed during the Trump administration. You just see $1 trillion plus deficits as far as the eye can see. So we've put ourselves in a position where I think that there's going to need to be some shift in how we view what we're doing from a fiscal position to see that growth in debt start to, it doesn't need to go down, but certainly the growth rate needs to slow. That growth line needs to start to flatten so that it can become a little bit more sustainable. And so I think that'll happen. But as we sit here today, we've got a presidential election coming up. Neither party owns the moral high ground on fiscal responsibility. So I'm not making a partisan statement here. We kind of view this purely just from a math standpoint. But neither party is even talking about fiscal responsibility because it's hard. The solution's going to be hard, and so it's going to eventually catch up with us.
So what would your message be for policymakers at the congressional level today? What should they be thinking about?
Look, I think the reality of it is, Todd, they're just going to have to review everything that we're doing from a spending standpoint, and everything. And I'm talking not just discretionary spending. I'm talking the entitlement programs and everything else. If you look at how the federal budget is set up, 60% of it's mandatory. That Congress doesn't even control that. In effect, autopilot. That's Social Security, Medicare, Medicaid, other types of income guarantees. The vast majority of that is indexed to inflation. So the government does have a vested interest in seeing inflation come down as well, because so much of our entitlement programs are tied to that. Well, what that means is that's 60% of the budget that's continuing to go up in spending. If you get to the 40% where we talk about the discretionary part, where Congress, this is when we get into these government shutdown discussions and all of this, there's really three big areas that you're talking to. The biggest today is defense spending. Now, I don't know exactly which way defense spending is going, but it doesn't appear to me that the world is any more stable today than it was 24 or 36 months ago. So at best, you would say defense spending is going to stay stable. I could build a pretty good case that it probably needs to go up some. The second biggest is interest expense. That's going higher, not just because the amount of debt that we continue to add. I read a stat the other day, we're adding $1 trillion in debt every 100 days in this country right now. That's a big number. And just as a quick aside on that, Todd, remember that was back in June of 2023 that we were bumping up against the debt ceiling at that time. And we were kind of approaching that day and nothing was getting done. Fitch, one of the three major rating agencies, S&P, Moody's, and Fitch downgraded us to AA+. And one of the things that they highlighted was this growing debt problem, but also the dysfunctional nature of our governmental processes. I'm not sure we've done anything to improve their view of our dysfunctional governmental process to begin with. But as we worked through that, we finally did come to that agreement. I think it's important to realize that when we raised the debt ceiling, that's the wrong term, because we didn't actually raise the debt ceiling. We suspended it. That meant that we put a date out there, January of 2025, and said, we're going to act like we don't have a debt ceiling between now and then. Now, that's been done before. It happened during the pandemic. It's happened in periods. And so that in and of itself was not necessarily a real issue. I do find it amusing that the name of the bill that suspended the debt ceiling was the Fiscal Responsibility Act of 2023.
A lot of irony in D.C., right?
kind of like the Inflation Reduction Act that they did. But since that time, it was at $31.4 trillion. The CBO estimated that we would add $4 trillion in debt between then and 2025. I've looked for anybody that will take $4 trillion or less because I want the over on a bet. I can't find anybody to take that. I'm suspecting that we're going to be even more than $4 trillion by the time we get to January of 2025. So
we're going to need some serious policymakers making some hard choices.
This is hard choices. And so when you're thinking about, and I'm almost 65 myself. So as I'm approaching retirement age and you start thinking about how that's going to impact entitlement programs. But let's keep this in mind. Even again, by the CBO's budget estimate, the Social Security plan is going to spend through its surplus by something like 2035, not that far into the future. If they allow that to happen, the current law is that every beneficiary of Social Security takes a 23% cut in their benefits. Now, that's pretty. I mean, here's the thing. Yes, you start talking about Social Security and, you'd start talking about things like maybe we should raise the retirement age, for not for me, but necessarily. And I'm not trying to be special there, but you just, you need some time to work that through. So it's, if you're 30 years or younger now, your retirement age isn't going to be 67. It's going to be 69 or something like that. Or you look at the FICA tax and you uncap the income that you're taxing while still capping the benefit that you're going to get. You start getting into stuff where maybe they have to start means testing beneficiaries of Social Security. So if you've been successful outside of that, how Medicare costs are going up rapidly, you've got to have those types of discussions. Because if you get down to just thinking about where you're going to cut spending, it's hard in military. It's not going to happen in the interest expense. You've only got about 15% of the government where everything else lives. So it's going to have to take a review of spending. It's a review of the tax policies. I don't know how you feel about it. I do my taxes every year, and it's a Saturday in March that I just write off. I just say this is going to be a bad day, and I go in and do it, and I get to the end and I use TurboTax, and at the end it says your effective tax rate is X, and I'm like, I would pay 2% more than that number to just not have to go through this. So I think there's some opportunities there, and and then not to belabor the point, but here's the other, as we think about policies that we could look to Washington to help us. A better way to deal with this is to find a way to grow the economy faster. Now, we just think of labor as a raw material for output. And if you want a rough idea of what the trend growth in our economy is, look at what your population growth is, add some productivity, which, it's running about 1.5% long term. It varies a lot. In fact, it went negative during the pandemic when people's salaries were going way up. But we're back to about 1.5%, 2%. That's where you get 2 to 2.5% on the potential growth rate. Well, if we could either improve productivity, that tends to come from the private sector. That is an opportunity for AI or some technology to continue to do that. Or we could find a way to grow the labor force faster. Now, organic growth is hard. Birth rates for a lot of developed countries are down.
And ours is down, correct?
U.S. is no different than that. This is where topics like immigration have to be dealt with. And I know that can become very political hot potato very quickly. But again, just thinking about this from an economic standpoint, just thinking about labor as a raw material for output, we need more of that. I know there are millions of people who want to come to this country and work, and it would make sense if we could find a way to ease that process to get those workers into our workforce, expand the output capacity of the economy. That also helps the Fed. Now, all of a sudden, they don't have to do as much with interest rates to try and lower demand because you've got actual supply in the economy coming up to meet that level of demand. And maybe that lets the Fed ease up on interest rates a little bit because we've actually got more output capacity in the economy. This can sound almost relatively easy from an economic standpoint. It's hard. I get it. These are, no one's going to sit here and say that everybody's coming across our border is a good person. That's not what we're saying. But we do know that historically, immigration has been a positive part of what we've done from an economic standpoint within our country. Having some sort of a cogent immigration policy would go a long ways towards helping us. Because look, let's be clear, 3.5% growth versus 2.5%. When we start thinking about everything that we might have to be doing from a tax or spending standpoint, man, more growth is way better than having to deal with all this stuff over here.
You're not wading into the politics of immigration. You're agnostic. You're just saying we need to figure it out.
I'm agnostic. Yeah,
let people in legally.
Thank you for letting me confirm that. Again, this is not a political statement. I'm thinking about this from a purely economic standpoint. There's plenty of anecdotal stories that we could talk about how difficult it is. And in fact, if you look at the employment data, there's a pretty big gap between the two surveys, the establishment survey and the household survey. And a lot of that could be immigration, illegal immigration that is kind of coming into this country that's not getting picked up in the household survey that's in the establishment survey. So, people that work in that part of it, whether it's construction or a number of different parts of our economy, they see that. It's the hard part about hiring a lot of people now, and we still have more open jobs than we do unemployed people. But what I hear from business owners about the difficulty in hiring people and for a lot of jobs is that you got two things. One is finding somebody who can pass a drug test. And that's a social issue that that I'm not going to try and solve today. But the other part of that is finding people that can clear the government's I-9 E-Verify process. And so I know it spurred a black market for Social Security numbers and federal ID numbers that these people want to work. They want to have a job. But I just look at that and go, there's got to be a better way, Todd.
Absolutely. And that's something that we need serious debate and policymakers thinking about this in a rational way.
Arizona could be a big beneficiary of that. I mean, as a border state, this is a front and center issue.
It is. I agree. On the other side, AI taking a bigger and bigger role in the economy. Maybe give us your thoughts on where AI is going as far as it relates to the economy.
It's really early to know for sure. I think that, our sense is, and certainly if you've looked at the stock market, AI has been what's driving the performance of kind of the top of the stock market. NVIDIA has been kind of the poster child, but it's Microsoft, it's all of them that are using AI. And I would just say from a company standpoint, we better be looking at AI as a tool. I know at BOK Financial, we're figuring out ways how to use AI as a tool to help us become more productive. The hard part of that is that means we can grow without adding as many people. But I think the biggest thing about AI as we think about it, two things. I go back to, you think about the stock market and the way that has moved. My mind immediately goes back to the tech bubble in 99 and 2000, where we saw the internet, explosion, and we saw a number of companies get huge valuations that were really not worth anything. There's a big difference in the companies that are getting the benefit of AI today versus what happened in the tech bubble. But here's the important part of that. What was really happening there in the internet bubble is what it turned out, the internet did revolutionize our entire economy. There's none of us that really can do our job anymore without having access to the internet, right? So AI has a similar type of a long term. I'm not sure what companies, even it may be a company that hasn't even been formed yet that's going to be the biggest beneficiary of that. I don't know if it's NVIDIA. It's hard for me to see a company that can continue to make a chip and have 80% profit margins forever without Intel just announced a potential competitor chip. Might be built right here in Phoenix.
That's the hope.
So, I think that as you look from an individual company standpoint, it's different. But AI as a technology, as we think about how that may move forward, huge promise.
A lot of opportunity and challenge out there.
Absolutely.
As we move forward. Briefly, you mentioned deflation. A lot of people would say, well, that sounds great. We can. We don't like inflation. Deflation must be the answer.
That's true unless you owe money. If you're not, and look, inflation's not that bad if you don't owe anybody money. It hurts you less. But deflation, particularly in a highly leveraged economy, think about this. If you've made a loan to a company, let's just say $1 million, and they have put up $1.5 million in collateral, their business starts to slow down. You think, okay, I've still got $1.5 million worth of collateral. Oh, wait a minute, that's not worth $1.5 million. It's only worth $900,000. Now I'm in a position where I might lose $100,000. The response to that is, as prices start to fall, creditors start to call in those credit lines faster because their protection against losing money is declining. And so you're right. Falling prices can feel good, and it's great. Let me personalize it from this standpoint. Living in Oklahoma, we're an energy state. As a consumer, I love it when gas prices fall. When during the pandemic, gasoline fell below $1 a gallon, right? And I was like, man, that's great. Wait a minute, no, that's bad, because there's so much of our economy that's driven by the oil and gas business. It can be beneficial. I would liken it to the paradox of thrift. As people save more money, that's good for them personally. That's bad from an overall economic standpoint. We need people spending money that turns money over in our economy and gets the velocity of the economy improving. So deflation can sound good. It can be good. It can also be very painful. That's why the Fed and Congress wanted to avoid that risk. The last big national deflationary environment we had was the Great Depression. I don't think anybody would look back at that and say that was a great period in our economy. We, living in Oklahoma, Texas, Colorado, energy states, in the mid to late 80s, we suffered deflation there as oil prices fell. That was hugely stimulative to the rest of the economy. But we saw real estate values fall 20-25%. We closed a third of our banks. We closed all of our savings and loans. It was a really painful period. So,
not the answer.
I'm not going to say inflation's good, right, but it's better than deflation.
Where I think Japan's been experiencing that for a number of years. So I know we're running near the end of our show, but I did want to ask a little bit about the U.S. dollar as the world currency. Yeah. Clearly, there's been some movement by China and others to destabilize us as the world currency. Where do you see that?
I want to go back to where I kind of think this started. Look, part of this is you just say, okay, what we're doing from our fiscal standpoint has to mean that the dollar is going down. And look, and that's what inflation is. It's a debasement of your currency. So that 20% CPI that I talked about, that's a debasement of our currency. Then that's just here domestically. Then if you're talking about the world's reserve currency, it's relative to what's going on in the rest of the world. And if we have one advantage, it is for the actions that we're taking. There's not a real clear opportunity or a real clear option in the rest of the world that you can point to and say, okay, that's a lot better. Now, part of this is there's only really three currencies today that could serve as the world's reserve currency. That's the dollar, the euro, and the yen. Okay. The euro's no better than we are. We just talked about the problems that Japan has. Now, then you say, okay, well, Steve, what about this consortium of companies called the BRICS? It's started out, the B is Brazil, the R is Russia, the I is India, the C is China, and the S is South Africa. Now, I could look at a couple of those countries, Russia and maybe China, as potential red flags to begin with. But here's the thing. To serve as the world's reserve currency, it's got to be freely trading with limited capital restraints. So you've got to be able to buy and sell that currency at any given time with no restraints on where that money's moving. This is why if people say, oh, it's China. China is the second largest economy in the world. I get it, but they're still an emerging market. And they still peg the yuan to the dollar. And if we think about how China considers what their economy is doing, they're a communist country, right? And communism as a political and economic principle is built on control. China wants to control their currency. That kind of flies in the face of what it would take to be the world's reserve currency. It's not surprising that China was the first country to do a central bank digital coin, CBDC, because that's totally built on control.
Okay.
I don't think that's the direction that we're going in the United States. I would not want to see us do that. But the other thing that really happened, Todd, is when Russia invaded Ukraine, and you think about how we responded to that. We're sending a bunch of money and arms to the Ukraine, but Russia had about $600 million in dollar-denominated reserves, and we cut off their access to those dollar-denominated reserves. So the effect was we weaponized the dollar-denominated Western financial system. So these other countries that may not be particularly friendly with us are thinking, maybe I need to have another alternative to this. Now, China still holds a ton of U.S. treasuries and a lot of dollar-denominated assets. Their potential action in Taiwan, which is a real geopolitical risk for stability around the world, what would the U.S. reaction be to that? Is it possible that we would cut off? I'm not saying I have any idea. I'm not saying that at all. But what I am saying is that these other countries said we need to have some other alternative than just the dollar. So there's going to be some move on the fringes. The U.S., the dollar is still about 58% of total global transactions. Maybe it goes to 55, maybe it goes to 52. But the concept of us not being the world's reserve currency, I would say this: we are abusing the heck out of that privilege. But there's just not another alternative. It's not China. It's not the BRICS. It's not Bitcoin. It's not gold. There's not enough gold in the world to support that. So
no more gold standard. We're not going back.
I just don't. There's just not enough gold to support it. So we still, ultimately think that the dollar is the world's reserve currency, but we would agree that there's some work we could do on our fiscal side that would improve our position.
No doubt. Well, you are so generous to come out now twice this year. You fly all over the country and generously give of your time, and you get a lot of questions, and I'm sure a lot of them are repeats. What's the one question that you wish someone would ask you that they never do?
I wish you would have. Wish you would have set me up for that a little bit, Todd. Look, it's maybe not a question, but I think that what concerns me as I travel and I talk is that there's a pretty broad sense of negativity. And we see this in the consumer sentiment numbers where consumer sentiment, even though unemployment is low, and if you listen to President Biden and his staff, it's like they're not getting any credit for how good the economy is. And so there's this underlying unease about, the economy's good, but what are we doing to get there? And so I think there's a growing willingness to think badly about our future. That bothers me. We are clearly still the greatest country in the world. this is where people want to come to have a better life.
Well, I'm glad I didn't set you up because that was a great answer. And I agree with you. I think we are. Having lived overseas for a number of years, you always look back and it makes you appreciate this country more and more when you look back at the amazing things that happen on a daily basis.
Yes.
Well, we're going to do a quick lightning round with you
Okay.
And learn a little bit more about you. Okay, first job.
First job was, the first job that I really remember making money because I wanted to was mowing lawns.
Okay, and what did you learn from that?
Well,
other than it's tough.
It is hard. At $5, I undercharged, I think, for I would mow, edge, and sweep for $5. But I was trying to save some money for a new tennis racket, and the new tennis racket, I was able to. First time I learned, hey, I can go make my own money and do this and not have to look at my mom and dad for a new tennis racket.
Okay, and so is the proper pattern sort of like long rows or the crisscross?
Well, I see like the baseball stadiums now, and they
love that.
That is not what I offered. That would have been $7.50 if I'd done that. No, I did pick up the grass. I just mowed it as quick as I could and swept an edge.
Excellent.
So,
and of course you did go to college and play tennis.
I did. Yes, I did. I went to a junior college in Midland, Texas. Grew up in Lubbock. Yep. Went to a junior college in Midland, Texas for 2 years, and then finished at Oklahoma State in Stillwater. Fantastic way to go through school. We got to play all over the country. OSU we were kind of in a period where our tennis team was good. Got to go to NCAAs my senior year. It was fun. It was great fun.
Okay, first car.
My first car was from my grandmother, 1968 Buick Wildcat, which is for anybody that knows those cars. It was a land yacht. This was a gigantic car, 444 4-barrel V8 in it. Got about 8 miles to the gallon. You could raise the hood and stand on either side of the engine to work on it. You could have a dinner party in the back seat.
All your friends fit.
The trunk was cavernous. I moved to and from school 3 times with a desk and a bicycle and all my clothes and didn't have anything in the front seat with me. So I wish I had that car now. It's a true classic. It could be really cool. I didn't realize just how cool I was at the time.
It's pretty darn cool.
She was happening. That's right.
Yeah, absolutely. Very good. Two wins there. First concert.
Is this the last question? Because this is going to embarrass me, Todd. So we lived in Guyman, Oklahoma. I don't know if anybody knows where that is, out in the middle of the panhandle of Oklahoma. My mom and dad, my dad was the principal of high school there. My mom was a teacher. We signed up at some grocery store was giving away a trip to Six Flags Over Texas.
It's good.
My dad won that trip. So we took a trip to Six Flags, and we didn't plan it this way, but after all day at Six Flags, we got to go to a concert and listen to the Captain and Tennille. So I listened to Tony Tennille singing about Muskrat Love, and that was the first concert that I ever went to, and I thought it was pretty cool at the time. But now, as I look back on it, I'm not so sure.
You can't go wrong with the Captain. Well, Steve, thanks for spending so much time with us, for coming to Arizona, for making sure that we really are in the know in terms of what's happening, and we'll look forward to having you back for Economic Outlook in September.
That sounds great, Todd. Love to be here and look forward to being back. Thanks.
All right. Thank you.